Hello, this is John Smallwood, Certified Financial Planner, Senior Wealth Advisor at Smallwood Wealth Management. Thank you for joining the podcast today. Today, we're continuing on the 19 sources of retirement income. Over the last couple of podcasts, I've been really focusing on each source, trying to dig down into the minutia, but yet stay high level so it's not too technical. But all of these things that I'm talking about, if you're prepared for them in the way that makes sense in your plan, you could benefit from these. And every single one of these has a unique tax treatment to it and also a pro and a con. And the idea is to develop these fully in your plan so you can take advantage of changing opportunities and really get yourself to a point where no matter what the future holds, because we know it'll be different than it is today, I can maximize income and still pass income to my family. Today, we're talking about the use of an immediate annuity. Now, before I get into what the heck that is, what I want to talk about is an annuity is a product that's offered by an insurance company. And you have many different types of annuities that are out there. You have a fixed annuity, which is typically invested with the insurance company, and it's invested in the general account of the insurance company. And I make interest on that. And if I don't take the interest out, the interest is tax deferred until I remove that. So let's say I put $100,000 in an annuity with an insurance company that's a fixed annuity. I'm going to receive interest, let's say 3%, could be 2%, 3%, I'm just using it as an example, and I don't pay tax on that. There are guaranteed interest rates that you can pick up. There are periods where you might get interest rates for a longer period of time and then they drop down. But the power of the annuity is that it's got an interest rate that is fixed, could be fixed for a period of time with a guarantee that's a floor. I'm not paying tax until I remove that out. And if I have a standard annuity and I put in 100,000 and I pull out 3,000 and I'm over the 59.5 level, that's taxed as ordinary income. Now, in the annuity, there's different variations of what I just called in that accumulation annuity where, and I'm trying to keep this simple, I can invest in different things. I can have a variable annuity that invests in, in essence, mutual funds. I can have a fixed indexed annuity that the insurance company picks an index and they give you a 0% to some participation rate so you can make more than the fixed account. But what we wanted to talk about today is the use of an immediate annuity and what that is in the plan and what some of the benefits could be for that. An immediate annuity is a decision where instead of putting the money temporarily with the insurance company, I'm saying to the insurance company, I'm going to give you this $100,000, and in exchange for that, I'd like to get a lifetime income. Now, this can be done in an IRA. It can be done in what's called a non-IRA, non-qualified asset, which is after-tax money. I'm going to focus on that today because that's where the tax benefits are. But what it does, if I'm a 70-year-old person and I'm married, let's say I have $100,000 sitting in the bank making $2,000 a year, that's not that exciting. And I might be paying tax on that. And inflation and financial pressure, et cetera, is causing us to have more money. Or on the other side, I just want to maximize and have more sources of retirement income and get a higher income payout. So when I do an immediate annuity, I say to the insurance company, here's that same $100,000. It's your money, but now in exchange, you're going to give me and my wife, my spouse, a lifetime income that we cannot outlive. So if we live to 100 plus, we're going to continue to get this income. That income could be somewhere between $5,500 and $6,000 on this $100,000 lump sum for a 70-year-old. Now, when I get that income, let's just pretend for a moment that it's $5,500, because I want you to get the concept, okay? So I'm getting that $5,500 a year for my entire life and my spouse's entire life, regardless of what happens. And if I happen to die, and my wife and I die prior to a certain time frame, you can have what's called a period certain, which means my beneficiaries, my children, will still get those payments that are remaining. And it could be a 10-year payout, it could be a 20-year payout. There are some nuances on there too. So you don't disinherit the family is what I'm trying to say, okay? The more refund that your family gets, the less income that you receive now. And the idea is to maximize the income. So I take that $100,000, I can now generate the $5,500, but there's also an annuity exclusion ratio that I benefit from, okay? So if I take that $100,000, and this is concept, right? About 4,000 of that 5,500 might be considered, I get this annuity exclusion ratio, which I'm only paying tax on $1,500, and 4,000 of that is considered a return of principal. So that exclusion ratio is allowing you to pay tax on just a little bit of interest. In this particular case, it might be less than what you were paying on before, but now you're getting you're getting your principal back. Now, typically the exclusion ratio, depending upon the calculation and what company you're doing with, is if you live longer than 20 years, the income after year 20 is going to be fully taxed. But again, it's lifetime income that's here forever. So there's a pro and a con to that. But you have to think about this also, the use of the immediate annuity. Again, let's think about that $1 million capital, that bucket of capital that I have. And let's say that I've got 200,000 sitting in a CD producing 2%. So I'm getting $4,000. The pressure for withdrawal is high. If I take 100,000 of that and I put it into this immediate annuity concept and I'm 70, and now I'm getting $5,000 from 100, and now that allows me to take less income from the other 100, but now let's say that's paying that 2%. I was getting 4,000 on the 200,000, $4,000 a year, completely taxable as ordinary income. So 4 nets to whatever, right? Now I do this 100,000 in the annuity. I get my 5 or 5,500. I'm only paying tax on a small portion of that. And I still have $2,000 worth of interest. So maybe I'm getting $7,500 of income from an asset that I was getting 4,000. That takes the pressure off of my withdrawal rates, and it's sustainable lifetime income. An immediate annuity is similar to creating a pension. It's like a private pension that you can create. Inside of this immediate annuity concept, there are nuances, and there are products that have income riders where you retain the investment, you get the same or similar income to it. There's lots of nuances, right? But the goal is, in the plan, I don't know how long I'm going to live, but the goal is, in retirement, I want to spend all of my money. I don't want to run out of money. And the day I die, I'd like my family to get all of the money that I have when I enter retirement and some of that appreciation. But for that to happen, I want the enjoyment of my money. I see so many people not enjoy their money, and they accumulate money, and they're not getting the full enjoyment from it. And when they pass, people inherit it, and they get the enjoyment from it, and they spend it, where the person who actually created it and kept it didn't really get the enjoyment from it. So the key is balance. I got to get balance to get the appreciation of my money and the hard work that I've had for my life. And the use of an immediate annuity can be very powerful. If you did this back in the 80s and interest rates were 7 and 8 and 9%, that was an amazing thing that you did. It might have seemed foolish at the time, and people might have given you flack, but here we are, 30, 35 years later, you've still got that sustained income, and that withdrawal rate's been 7 or 8%. Go back to, one of our other podcasts where we talk about with the withdrawal rate, and today the sustainable withdrawal rate is 3.5% to 4%. So the immediate annuity, despite the interest rates being low compared to historical interest rates, it's still a great strategy. And as inflation and planned obsolescence and technological change continue to beat down on us, this is something that I think you could continually, utilize to increase your income as long as you have the right strategy. Now, you think about it, again, that life insurance product that we talked about, the dividends, and then we talked about the use of the death benefit maybe for a reverse mortgage. Now I turn on an immediate annuity. The life insurance is replacing those assets if I happen to live too long, which is a good thing, last I checked, right? I want to live as long as I possibly can and enjoy life as much as I fully can, be a contributor as long as I possibly can, be a steward of my money and pass money on to my family the maximum that I can, but I really want to enjoy it at the fullest. So hopefully this gives you a good level of understanding. It was clear, it was concise. What I would like to offer to you, if you're one of our clients, is to come back and do a review and explore how this type of vehicle might work in your plan. If you're new to us, set up a wealth curve pressure identifier conversation, have a 30-minute no obligation call with a financial advisor and determine where you are, what of the 19 sources do you currently have, how can I prepare my money to get more of those 19 sources of retirement income, and am I allocated in the right way to maximize all of my benefits that I have available to me. You can also go to our website and download or request a free copy of 5 Ways Your Wealth is Under Attack, the 19 sources of retirement income is available for a download. You can download that and get it quickly. But the real benefit is taking action and talking to a financial advisor and having a financial advisor that you really feel comfortable with. That's important. Thank you for listening. We'll be going into the other ones at the next podcast. And if you have an idea for a podcast, we'd love to hear it because we'd love to do it. A guest, something, whatever you're thinking. We'd love to hear from you. Thank you.
Welcome to the end of the video. Smallwood Wealth Management is an investment advisor representative. The opinions expressed by Smallwood Wealth Management and guests on this show are their own. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented for this educational purposes only. Moreover, no listener should assume that any discussions or information presented serves as a receipt of or substitute for personalized advice from Smallwood Wealth Management or from any other investment professional and is not intended as an offer of solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Smallwood Wealth Management is not a law firm or an accounting firm, and no portion of this presentation should be interpreted as legal, accounting, or tax advice. Information expressed does not take into account your specific situation or objectives and is not intended as a recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Thank you for listening.